over 3.5 million accounts were fake. This astonishing revelation rocked Wells Fargo, a bank once seen as a pillar of trust in American finance. The institution faced immense scrutiny after reports emerged of its widespread misconduct spanning nearly 6 years, from 2011 through 2016, where employees under pressure opened customer accounts without proper authorization, often without the customer's knowledge. This predatory practice saw roughly 500,000 credit card applications created without consent, and around 2,800,000 customer accounts potentially impacted. The push for aggressive sales targets, particularly in the internet race for digital dominance, led to a toxic culture where branch staff were compelled to meet impossible quotas. This desperate pursuit of new customer numbers and online engagement figures obscured a serious systemic failure to adapt technologically. Instead of innovating with user-friendly online platforms and secure digital banking solutions, Wells Fargo pushed its employees to artificially inflate its customer base numbers, making it seem like they were winning the digital battle, when in fact they were failing. The bank's digital stumble was not merely a technological shortcoming, but a moral one, fueled by a lack of proper oversight and a relentless focus on short-term gains. Following the scandal, 5,300 employees were terminated for their involvement. The financial penalties were staggering, with a landmark $1.9 billion settlement agreed upon with various regulatory bodies, including the Consumer Financial Protection Bureau and the Office of the Comptroller of the Currency. Additionally, 50 states settled with the bank for another $575 million, bringing the total to well over $2.5 billion in fines alone. The bank also paid out around $190 million in customer refunds, directly to those harmed by these egregious practices. Its market value plummeted by an estimated $16 billion within a year, and its stock price dropped by over 25%, severely impacting shareholder confidence. The aftermath included a strict 10-year consent order from regulators, demanding comprehensive reforms in governance, risk management, and corporate culture. Wells Fargo was forced to rethink its entire operational structure and sales practices, abandoning its aggressive cross-selling strategy that incentivized the creation of these fraudulent accounts. The path to regaining trust has been arduous, with the bank undertaking a massive restructuring effort to rebuild its tarnished image and address its fundamental flaws in ethics and digital strategy. Its failure to genuinely compete in the evolving digital landscape, compounded by its internal fraudulent activities, serves as a stark warning about the true cost of prioritizing metrics over integrity and customer welfare. The company continues its journey to recover from one of the most significant banking scandals in modern history, acknowledging its deep-seated issues that led to such a profound loss of public trust and billions of dollars in penalties and lost business. The lessons learned from this period are still echoing throughout the financial industry, emphasizing the importance of ethical leadership and genuine digital transformation, rather than superficial growth. Millions of phantom customers appeared on the books. Wells Fargo, a banking giant, found itself drowning in its own creation. Truth emerged over 6 years, from 2011 through 2016, marked by aggressive sales goals and ethical failures. 3.5 million fake accounts employees opened under intense pressure, including 500,000 credit card applications created without consent, and 2,800,000 customer accounts impacted by these predatory practices. Digital dominance pursuit and internet race led to a toxic culture where impossible quotas forced branch staff into illicit actions. Instead of innovating with user-friendly online platforms, the bank artificially inflated its customer base, giving a false impression of success. Not just a tech failure, This was a profound moral lapse, driven by oversight lack and a relentless focus on short-term gains at any cost. Fallout was immense and swift. Over 5,300 employees were terminated for their involvement, a staggering number reflecting widespread misconduct. Financial penalties proved astronomical. A landmark $1.9 billion settlement was reached with regulators like the Consumer Financial Protection Bureau and the Office of the Comptroller of the Currency. 50 states settled for another $575 million, bringing total fines to well over $2.5 billion. Beyond fines, $190 million was paid directly to customers in refunds, those harmed by these egregious practices. The bank market value plunged $16 billion within a single year, and its stock price tumbled more than 25%, severely eroding shareholder confidence. Regulators imposed a strict 10-year consent order, demanding extensive reforms in governance, risk management, and corporate culture. Wells Fargo rethought its operational structure, abandoning its aggressive cross-selling strategy that had incentivized fraudulent accounts. Rebuilding trust proved extremely challenging, involving massive restructuring to repair its tarnished image and address fundamental flaws in ethics and digital strategy. Its monumental failure to genuinely compete in the evolving digital landscape, exacerbated by internal fraud, stands as a stark warning about the true price of prioritizing metrics over integrity and customer welfare. The company continues its arduous recovery from a most significant banking scandal, acknowledging deep-seated issues that led to a profound loss of public trust and billions in penalties and lost business. Lessons from this dark period resonate throughout the finance industry, underscoring vital ethical leadership and authentic digital transformation, far beyond superficial growth. Billions of dollars vanished simply because integrity was lost. Wells Fargo, the prominent banking giant, faced an unprecedented crisis that extended far beyond mere financial penalties. The price of failure was paid in profound loss of public trust, a critical blow to its century-and-a-half-long reputation. This scandal, starting around 2011 and fully exposed by 2016, revealed a deep systemic flaw where 3.5 million fake accounts, including 500,000 unauthorized credit cards, were opened by staff under immense pressure. More than 2.8 million customer accounts were directly impacted by these predatory actions. The bank lost $16 billion in market value within 1 year, and its stock price plummeted over 25%, eroding shareholder confidence. Over 5,300 employees were terminated, a clear sign of widespread misconduct and a toxic sales culture. Regulators levied astronomical fines, totaling well over $2.5 billion, including a $1.9 billion settlement with bodies like the Consumer Financial Protection Bureau and the Office of the Comptroller of the Currency. 50 states added another $575 million to that tally. Beyond fines, $190 million was directly refunded to customers who were harmed. A strict 10-year consent order was imposed, demanding extensive reforms in governance, risk management, and corporate culture, a monumental task for nearly any institution. The aggressive cross-selling strategy that incentivized this fraudulent behavior was finally abandoned. Rebuilding trust became a monumental and ongoing challenge, requiring massive restructuring to mend its tarnished image and address fundamental ethical and digital strategy flaws. The lessons learned from this dark period resonate throughout the finance industry, underscoring the vital importance of ethical leadership and genuine digital transformation, far beyond superficial growth. This episode remains a stark warning about the true cost of prioritizing metrics over integrity and customer welfare. Wells Fargo still grapples with the long-term implications, striving to demonstrate a renewed commitment to ethical practices and consumer protection, a journey that will undoubtedly span many more years following the egregious misconduct that impacted millions.